All right, credit scores are a tricky subject. I think most of us can agree. And all too often I've found that most folks have been sorely misguided when it comes to their credit scores. So in today's video, I wanted to cover the 10 most common credit scoring myths that are negatively affecting Americans and their ability to use their credit wisely. Let's go ahead and dive in. All right, myth number one. Checking your credit score will lower it. That's one of the most common myths out there. Many people believe that their credit scores will be lowered because of it, but that's just simply not true. In fact, checking your credit score regularly can actually help you monitor your credit as well as protect your own identity from theft or any errors that could be negatively affecting your scores. There are many resources that are out there for checking your credit scores. Some you pay for, others are free. I would always recommend going with the free resources that are available first, as they will give you a solid idea as to what your credit score is looking like despite using a different credit scoring model to get there. Credit Karma, probably the most well-known. It's a great resource. It's one that I recommend first and foremost to everybody. They use the Vantage scoring model, and it does vary slightly from the FICO Fair Isaac credit scoring model, which is the most popular model that's used industry-wide by most banks and credit unions. But like I said, the Vantage credit scoring model will certainly get you in the ballpark of what your FICO scores would look like, and thus is extremely useful in helping you understand where you're at. And then that leads us to the second credit scoring myth here, which is that you only have one credit score. This is another really common credit scoring myth that it's just simply not true. In fact, you have multiple credit scores, and they can vary depending on the credit bureau as well as the scoring model that's used. It's important to understand that each credit score is calculated differently, and it can impact your ability to obtain credit. Like I said earlier, the FICO credit score is the most popular credit scoring one out there, but you can get by with using the Vantage model through Credit Karma day to day while only checking your FICO once a month. Most credit card providers offer one free FICO credit scoring per month, so I'd recommend looking there so that you can continue to avoid any paid credit scoring services that are available, including through Fair Isaac directly. All right, on to myth number three. Closing a credit card will improve your credit scores. This is a common credit scoring myth that can actually harm your credit scores. It'll have the reverse impact. Closing a credit card can reduce your available credit, thus increasing your credit utilization rate, which can negatively impact your credit scores, quite greatly, in fact. Beyond its effect on your utilization rate, which does influence 30% of your credit scores, closing a credit card can also negatively affect the length of credit history, which is worth 15% of your credit score. So instead of closing that credit card account, consider keeping your credit card open and using it responsibly. The only times I would generally recommend somebody perhaps consider closing a credit card is to avoid an annual fee, or if you happen to be a co-borrower or co-signer on a credit card with somebody else. Usually that is heavily discouraged just because you don't want any of your possible great credit to be at risk or vulnerable to somebody else's behavior. So those would be the only two exceptions to that rule. Now, myth number four is paying off a debt will immediately improve your credit score. While paying debt off is always a good idea, I mean, arguably there are some exceptions to that too, but almost always a good idea, it may not immediately improve your credit scores. Your credit score is going to be based on a variety of different factors. It includes your payment history, it includes your credit utilization rate, the length of credit history, and it can take time for your credit score to reflect positive changes. So be patient and continue to use your credit responsibly. The fifth myth on my list is that you don't need credit if you have cash. Dave Ramsey may differ with me on this one, but while it's true that cash can be a great way to manage your finances, having no credit history can make it difficult to obtain credit when you actually need it. And without a credit history, lenders might actually view you as a higher risk borrower and then charge you higher interest rates, or even deny your application entirely. So it's important to establish and maintain a good credit history to ensure your financial health and build your wealth over time. Myth number six is that you need to carry a balance on your credit card to build credit. This is a very common misconception, and it actually can harm your credit scores as well. Carrying a balance on your credit card can lead to a higher interest charge, and then it can make it difficult to pay off that debt, which then increases your credit utilization rate even further. The best way to build credit is to use your credit card responsibly, pay off your balances in full every single month, and keep your utilization rate as low as possible, 0 being the best possible dollar amount. Now, the seventh myth is that your income affects your credit score. The income does not have any effect on your credit score. However, lenders do always consider your income when evaluating your credit worthiness and determining your ability to repay a loan or credit card balance. They may not require you to prove it, but they do care about it. It's important to have a stable income and manage your finances responsibly, of course, to maintain a great credit score. I've got a quick credit scoring boost trick that I think relates to this one. Anytime your income grows, be sure to reach out to your credit card providers in order to let them know and ask for a credit limit increase on the account. Doing that can help your credit utilization ratio remain lower while using your accounts, which can in turn boost your credit scores. The eighth myth on my list is that your credit score is the only factor that lenders consider when evaluating your credit worthiness. Like I just mentioned, while your credit score is an important factor to lenders, it's not the only factor. Lenders are almost always going to consider your income, your employment history, your debt-to-income ratio, as well as other factors when evaluating your overall borrowing strength. So it's important to understand all of the factors that lenders are going to care about, specifically the lender that you want to work with, and make sure to improve those factors in order to increase your chances of getting approved for whatever tool you're applying for. The ninth myth is that your credit score is always accurate. Credit scores are really only as accurate as the information that's on your credit report. So if there are errors or any inaccuracies on your credit report, your credit score may not reflect your true credit worthiness. So it's important to review your credit report regularly and dispute any errors or inaccuracies to ensure that your credit score is accurate. You can usually do that directly from the credit scoring website, like Credit Karma, for instance. I can't stress enough, though, how much of an impact this can have on your credit scores. It's certainly worth the time and effort. At one time, I heard that over 80% of credit reports have something erroneous on them. Now for our last myth today, number 10, which is that paying off collection accounts will improve your credit scores. While paying off collection accounts is always a good idea, it may not immediately improve your credit scores. Collection accounts can stay on your credit report for up to 7 years, and even if you pay them off, they may still impact your credit scores because it resets the date of last activity. So paying off collection accounts can actually show lenders that you're taking steps to manage your debts responsibly, and it might help you get approved for a credit line in the future, but it might hurt you in the short term. I actually did a deep dive on the best way to approach collections in a previous video. So for anybody that has collections and you want to know how to come out on top in that situation, make sure you check the link in the description below for that. In conclusion, understanding credit score myths is essential to achieving financial health because prioritizing your credit early on is one of the first steps to building wealth over time. By checking your credit scores regularly, keeping your credit card open, paying off debts responsibly, and establishing and maintaining a great credit history, you can ensure that you're using credit wisely and making the most of your financial resources. I do appreciate you watching today's video. Don't forget to like and subscribe to the channel, and please share the video today with anybody that you think would benefit from it. I look forward to seeing you on the next one. Until then, make it a great day today and keep on cash flowing. Take care.